A question that I get a lot is to do a full dividend portfolio breakdown. So here we are. In this video I will show you my dividend portfolio breakdown and explain why I invested in these specific stocks. I'm very excited to see what you guys think about these stocks, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So here we go. This is my full portfolio as of right now. The three green marked stocks are my biggest positions, which I will cover in a minute. Let's start with the sector classification. Roughly 24% of my portfolio is invested in REITs. It's not the biggest sector in this portfolio, but it's definitely the one that brings in the highest amount of dividend. The next sector is tech, representing 15% and consisting some dividend growth stocks. Health is by far the smallest sector with only 4%. Services is the biggest segment with 26% and has a broad variety of different companies. As of right now, I only have one ETF in my portfolio, which is the S&P 500 ETF, representing 17%. Last but not least, we have the finance, which together with the REIT sector brings in the most dividends. There are endless ways of doing a portfolio breakdown and classify everything. I decided to do it this way. On the left we see the breakdown on an individual stock level. As of right now I only own 15 different stocks. I used to own 20 to 30 stocks, but I locked in some profits and decided to trim down the amount of different stocks. My cash position isn't included in this list, since I will create a separate video very soon. As I told a minute ago, 3 stocks are highlighted in this list, since they are the biggest amount of share. Microsoft representing 11% and being my biggest singular stock pick. And on the second spot we have Starbucks sitting at 10% share. My biggest position is in the S&P 500 ETF representing 17%. My smallest position is Texas Roadhouse with only 2%, which is very interesting, but more on that later in this video. Let's dive into the specific companies that I have invested in. I will be checking the stock price year to date, some basic fundamentals and the dividend scorecard. Let's start with the first stock in this list, Ready Capital. Ready Capital is a multi-strategy real estate finance company that originates, acquires, finance and services small to medium-sized balanced commercial loans. The stock is down 10% year to date and sitting around $10. As of right now, Ready Capital represents only 3% of my portfolio, and the reason being the high risk, high reward ratio. Ready Capital is a 1.14 billion market cap company, indicating it's a smaller size company. PE ratio is really low, only sitting at 5.8 right now. The reason why I invested in this stock is because of the dividends. I think it's one of the first stocks that I invested in. My average cost price is around $13, so I'm down in this one, but to be honest I don't care that much. It's all about the dividend with this one. Dividend yield is sitting at almost 16%, and to be honest this is insane. When I started my position I think dividend yield was around 7%, which was already a bit on the high side. But since the stock price has come down quite a lot lately, the dividend yield has increased all the way up to almost 16%. Payout ratio is at 93%, indicating it could be a risk investing in this company. The 5-year growth rate isn't that spectacular to be honest. But who needs growth right now when dividend yield is this high? They grew the dividends for 2 consecutive years. My final conclusion on Ready Capital is that it's a high risk, high reward investment. There were times I was planning to sell this position because of the increasing payout ratio, especially with interest rates increasing now. This company might be at risk. In the coming period I will decide whether or not to sell this stock. For now I will keep collecting the dividends. Next stock on this list is Stag Industrial. I have covered this stock many times on the channel, and with reason. Stag is a real estate investment trust focused on the acquisition and operation of industrial properties throughout the United States. The stock is up 3% year to date and is sitting around $33. As of right now, Stag Industrial represents 6% of my portfolio, and the reason being the monthly dividends. Stag Industrial is a 5.97 billion market cap company, indicating it's a smaller sized company. PE ratio isn't a fair metric to use with REITs, so I will be using the price to FFO, which is sitting at 15. A decent number for a REIT. The reason why I invested in this stock is because of the monthly dividends. I think it's one of the first stocks that I invested in. My average cost price is around $30, so I'm up roughly 10% in terms of stock price. But as I just said, it's more about the dividends for me. Dividend yield is sitting at 4.4%, and the best thing about Stag is the fact that they pay a monthly dividend. The payout ratio displayed here isn't correct since REITs use FFO to pay out the dividend. The actual payout ratio is 66%, which is a great number for a REIT. The 5-year growth rate isn't that spectacular, to be honest. But who needs growth right now when dividend yield is already at 4.4%? They grew the dividends for 11 years in a row, which is pretty nice. My final conclusion on Stag is that I love the business. I do think the stock could be undervalued right now, and with dividend yield sitting at 4.4% and of course the monthly payout, this is a great dividend stock. I will slowly increase my position every now and then, especially when the stock price drops to my cost average. Next stock is Abbvie, a pharmaceutical company famous for their top drug Humira, but also famous for paying a great dividend. The stock is down 1% year to date and is sitting around $160. As of right now, Abbvie represents only 4% of my portfolio. Abbvie is a $282 billion market cap company, which makes them one of the largest pharmaceutical companies in the world. PE ratio is sitting at 23.8, indicating that you pay a small premium for the stock right now. The reason why I invested in this stock is because of the dividend growth. This is again one of the first stocks that I invested in. I opened my first position at around $100 and bought some more shares during a dip. Right now, my cost average is around $120. Dividend yield is sitting at 3.69%, which is a really good number, and one of the reasons why people love this stock. Payout ratio is at 41%, which is pretty good, leaving them with enough space to do research, pay down debt and buy back shares. The 5-year growth rate is almost at 17%, and one of the main reasons why I invested in this company. They are able to grow the dividends at a high pace, which I really like. The dividend growth in terms of years is sitting at 9, which is also pretty good. My final conclusion on Abbvie is that I really like the business. It has to be said that pharmaceutical companies come with more risks because of the drugs getting disapproved or losing patents, which is the case with Abbvie. To me, this isn't a high risk, high reward company since they have other top drugs increasing at high pace as well. For now, I will slowly increase my position whenever the stock drops. I'm also planning to increase the healthcare sector in general, so that I'm not only betting on Abbvie. Next stock on this list is Realty Income. I have covered this stock many times on the channel, and with reason. Realty Income is a real estate investment trust focused on single-tenant commercial properties. The stock is down 1% year to date and is sitting around $62. As of right now, Realty Income represents 6% of my portfolio, and the reason being the monthly dividends. Realty Income is a $40 billion market cap company. PE ratio isn't a fair metric to use with REITs, so I will be using the price to FFO, which is sitting at 15.6. A decent number for a REIT. The reason why I invested in this stock is because of the monthly dividends. It's the most famous monthly paying dividend stock due to its track record of 26 years of dividend growth and dividend yield sitting at 4.8%. The payout ratio displayed here isn't correct since REITs use FFO to pay out the dividend. The actual payout ratio is 76%, which is a great number for a REIT. The 5-year growth rate isn't that spectacular, to be honest, but I'm okay with that since dividend yield is already at 4.8%. My final conclusion on Realty Income is that I love collecting the monthly dividends. It has a proven track record and the current valuation isn't that bad. However, REITs come with more risks, so that's why it's sitting at 6% of my portfolio right now. I'm planning to increase my shares every now and then. Next stock on this list is Microsoft, the largest single stock in my portfolio sitting at 11% of my total portfolio. The stock is up whopping 20% year to date and is sitting around $287. In my opinion, Microsoft is a great combination of ticker growth and dividend income. Microsoft is a 2.14 trillion market cap company, which makes them one of the largest companies in the world. PE ratio is sitting at 31, indicating that you pay a premium for the stock. The reason why I invested in this stock is because of the growth and the dividend income. Microsoft is also one of the first stocks in my portfolio, and I think I bought it at 260 or something. I would love to have a lower average cost price, but right now I'm buying the dip whenever it occurs. Dividend yield is sitting at 0.95%, which is of course a low number. Payout ratio is at only 28%, which is a really good number, leaving them with enough space to do research, pay down debt and buy back shares. The 5-year growth rate is at almost 10%, and one of the main reasons why I invested in this company. They are able to grow the dividends at a high pace, which I really like. They also grew the dividends for 18 years in a row. My final conclusion on Microsoft is that I love the business. Right now you pay a premium for the stock, but to be honest, it may be worth it. Microsoft is one of the fewer companies to do well in almost every economic circumstances. And they are one of the largest companies in the world that's able to grow double digits in revenue, which is insane. For now I will be waiting for the dip, and whenever the stock price drops I will increase my position. Next stock on this list is Arbor Realty Trust. Arbor Realty Trust provides loan origination and servicing for multi-family and single-family rental. The stock is down 16% year to date and is sitting around $11.4. I'm not going to lie, this hurts. I have a cost average of roughly $15 on this stock and I'm down quite a bit. But the good part is I didn't invest for the ticker price return, but the dividends. As of right now, ABR brings in the most dividend in my whole portfolio and only sitting at 4% share of my total portfolio investment. ABR is a 1.94 billion market cap company with PE ratio only sitting at 5.95, which is a really low number of course. The reason why I invested in this stock is because of the dividend income. Dividend yield is sitting at almost 14%, which is of course an insane number. Payout ratio is at 94% and is pretty much the same story as with Ready Capital. High risk, high reward. The 5-year growth rate is at 16%, which is kinda surprising. They also grew the dividends for 9 years in a row. My final conclusion on ABR is that I love seeing the dividends coming in every quarter. As said earlier, this stock brings in the highest amount of dividend and only represents 4% of my total investment. But to be honest, I'm not planning to buy new shares, even with the share price this low compared to my cost average. Companies like ABR and RC have a really high risk, high reward ratio, and right now these companies combined represent 7% of my total portfolio. I want to lower this number to 5% this year, and maybe even a lower number in the future. Nevertheless, it's a great dividend income stock for right now. Next stock on this list is Visa, one of my favorite companies and stock in my portfolio. I just love this one since the first day I started investing in this company. The stock is up 10% year to date and is sitting around $229. Right now Visa represents 6% of my total portfolio. Visa is a 480 billion market cap company, which makes them one of the largest companies in the US. PE ratio is sitting at 27, indicating that you pay a premium for the stock. But please take a moment to look at the profit margin and gross profit margin. It's sitting at an insane number and they are a real money machine. The reason why I invested in this stock is because of the growth and dividend income. Visa has been in my portfolio for a while and my cost average is around $200. I would love to have a lower average cost price, but right now I'm buying the dip whenever it occurs, which is kinda rarely. Dividend yield is sitting at 0.79%, which is of course a low number, and if I'm not mistaken, the lowest number in my whole portfolio. Payout ratio is at only 20%, which is really good, leaving them with enough space to do research, pay down debt and buy back shares. The 5-year growth rate is at 17.5% and one of the main reasons why I invested in this company. They are able to grow the dividends at a high pace, which I really like. They also grew the dividends for 14 years in a row. My final conclusion on Visa is that I just love this company. I really hope the stock will go down so I can buy at lower prices. But to be honest, I don't think this will happen very soon. The dividend yield is of course not that high, and PE ratio is sitting at a premium right now. Nevertheless, Visa is a high quality stock, in my opinion, so they might be worth it. Next stock on this list is Starbucks, also one of my favorite companies and stock in my portfolio. I waited so long for the stock to come down and open my first position. Starbucks is up roughly 4% year to date and is sitting around $104. Right now, Starbucks represents 10% of my total portfolio, being my second biggest singular stock investment. Starbucks is a 120 billion market cap company, which makes them the largest coffee chain company in the world. PE ratio is sitting at 36, indicating that you pay a premium for the stock. The reason why I invested in this stock is because of the growth and dividend income. Starbucks has been in my portfolio for a while right now, and my cost average is around $80. I would love to see the stock price to go down to this number again. Dividend yield is sitting at 2%, which is of course a great number. Payout ratio is at 68%, which is a bit on the high side. I would love to see 50% or lower. The 5-year growth rate is at 13%, and one of the main reasons why I invested in this company. They are able to grow the dividends at a high pace, which I really like. They also grew the dividends for 12 years in a row. My final conclusion on Starbucks is that it's one of the most interesting companies in my portfolio right now. It's a huge coffee chain company with so much potential outside the US. For now, I'm waiting for the dip to increase my position, and I can't wait to buy the stock at lower prices actually. Next stock on this list is HomeDepot, and again, also one of my favorite companies and stocks in my portfolio. HomeDepot is down roughly 6% year to date and is sitting around $297. The stock has gone up and down quite a bit in a range of $340 to $280 year to date. Right now, HomeDepot represents 8% of my total portfolio, being my third biggest singular stock investment. HomeDepot is a 302 billion market cap company, which makes them the largest do-it-yourself store in the world. PE ratio is sitting at 17, which is pretty decent for this type of company. The reason why I invested in this stock is because of the dividend growth. HomeDepot has been in my portfolio for a while, and I could have taken my profits and sell the stock when it hit $330, since my average cost price is around $290. But I didn't. I just love the dividend income and I keep buying the dip. Dividend yield is sitting at 2.8%, which is of course a great number. Payout ratio is at 46%, which is pretty decent in my opinion. The 5-year growth rate is at 16%, and one of the main reasons why I invested in this company. They are able to grow the dividends at a high pace, which I really like. They also grew the dividends for 13 years in a row. My final conclusion on HomeDepot is that I just love the dividends. They are the market leader and a steady and consistent company. They are not growing at double digits every year, but that isn't what I need. What I need is a steady and consistent, and above all, a safe dividend income. For now, I will slowly increase my position every time the stock drops to my cost average. So at these prices, I really like HomeDepot. Next stock on this list is TROW Price, ticker symbol TROW. This is an American publicly owned global investment management firm. TROW is up roughly 3% year to date and is sitting around $112. Right now, TROW represents 6% of my total portfolio. TROW is a 25 billion market cap company with a PE ratio sitting at 16, which is pretty decent for this type of company. The reason why I invested in this stock is because of the dividend growth and a proven track record when it comes down to dividends. TROW has been in my portfolio for a while and with reason. Dividend yield is sitting at 4.3%, which is of course a great number. Payout ratio is at almost 60%, which is above my 50% maximum. But they had some disappointing results which lowers their free cash flow. This is a short-term problem and doesn't hurt the long-term in my opinion. The 5-year growth rate is at almost 15%, and one of the main reasons why I invested in this company. They are able to grow the dividends at a high pace, which I really like. They also grew the dividends for 36 years in a row, which is really impressive. If I'm not mistaken, this is the stock with the most consecutive years of dividend growth in my portfolio. My final conclusion on TROW is that I just love the dividend yields and growth numbers. This company faces some short-term problems, but long-term I'm not worried that much. For now I will slowly increase my position since they are a little bit above my cost average right now. Next stock on this list is Texas Roadhouse, ticker symbol TXRH. The name gives it away already, a restaurant chain company. TXRH is up 17% year to date and is sitting around $109. Right now TXRH represents 2% of my total portfolio, being my smallest investment right now. But that is about to change very soon. TXRH is a 7 billion market cap company with PE ratio sitting at 27, which means you pay a premium for the stock. My cost price is around $85, so I can't wait for the stock price to come down and I buy at lower prices. The reason why I invested in this company is because of the growth potential, but also the great management and the great dividends. Dividend yield is sitting at 2%, which is of course a great number. Payout ratio is at 46%, which is just below my 50% maximum. The 5-year growth rate is at almost 17%, and one of the main reasons why I invested in this company. They are able to grow the dividends at a high pace, which I really like. During the lockdown periods they cut the dividends because most of its restaurants got closed. A great move in my opinion to save up some cash, and as soon as things started to cool down they increased the dividends again at a high pace. My final conclusion on TXRH is that I love this company. It's a great dividend stock with a lot of potential to grow in revenue and size as well. The PE ratio is a little bit too high in my opinion, and I can't wait to load the boat when the stock price comes down to around $100. For now I will slowly increase my position and keep collecting the dividends. Next stock in this list is Arbor Realty, ticker symbol ADC. Another REIT with monthly dividends. ADC is a real estate investment trust primarily engaged in the acquisition and development of properties net leased to industry-leading retail tenants. The stock is down 4% year to date and is sitting around $67. As of right now, ADC represents 6% of my portfolio, and the reason being the monthly dividends. This is also my most recent buy since I do believe long term in this company and collect the great monthly dividends. Arbor Realty is a 6 billion market cap company. PE ratio isn't a fair metric to use with REITs, so I will be using the price to FFO, which is sitting at 15.75, a decent number for a REIT. The reason why I invested in this stock is because of the monthly dividends. Dividend yield is sitting at 4.24%, which is a great number of course. The payout ratio displayed here isn't correct since REITs use FFO to pay out the dividend. The actual payout ratio is 66%, which is a great number for a REIT. The 5-year growth rate is pretty nice as well, sitting at 7%, and they grew the dividends for 10 years in a row, which is also very nice. My final conclusion on Arbor Realty is that I started to like this company more and more lately. At current prices it seems like a good deal to me. They are undervalued in my opinion and also bring in a great amount of dividend every month. I will keep increasing my position this year and I can't wait for the stock price to go down even more. Next stock in this list is Extra Space Storage, ticker symbol EXR. This is a REIT focusing on self-storage units in the United States. The stock is up 7% year to date and is sitting around $154. As of right now, EXR represents 6% of my portfolio, and the reason being the great dividends and the niche industry. Yesterday they announced to have plans to buy one of their main competitors, Live Storage, which is pretty interesting and could change the whole game of self-storage REITs. Extra Space Storage is a 20 billion market cap company. PE ratio isn't a fair metric to use with REITs, so I will be using the price to FFO, which is sitting at 19. In my opinion, a little bit too high right now. The reason why I invested in this stock is because of the great dividends and growth potential. Dividend yield is sitting at 4.19%, which is a great number. The payout ratio displayed here isn't correct since REITs use FFO to pay out the dividend. The actual payout ratio is 80%, which is a decent number for a REIT. The 5-year growth rate is pretty impressive, sitting at 14%, and they grew the dividends for 12 years in a row, which is also very nice. My final conclusion on EXR is that I love the company and the niche industry. They pay a great dividend and for a REIT it's pretty steady. With the plans to buy one of the main competitors, things could change drastically within this industry. The current valuation is a little bit too high in my opinion, so I can't wait to see the stock price go down and buy at lower prices. Last stock on this list is Qualcomm, ticker symbol QCOM, a semiconductor that has been around for a while. Qualcomm is up 16% year to date and is sitting around $124. Right now, Qualcomm represents 5% of my total portfolio and is also one of my most recent buys. Qualcomm is a 140 billion market cap company with PE ratio sitting at 13, which is pretty interesting. The reason why I invested in this stock is because of the growth potential, but also the great dividends. Dividend yield is sitting at 2.4%, which is of course a great number for a tech company. Payout ratio is at only 25%, leaving them with enough room to grow the business, do acquisitions, pay down debt and buy back shares. The 5-year growth rate is at almost 6% and they grew the dividends for 19 years in a row, which is also pretty impressive. My final conclusion on Qualcomm is that I really like the business. I'm long term on this stock and at current prices they seem undervalued to me. Next to that, they pay a great dividend and have a proven track record. I'm planning to increase my position big time very soon. Until then, I'm waiting for the stock price to come down just a little bit more because I love to buy at lower prices. Last but not least, we have my final investment, which is the S&P 500. The main reason why I heavily invested in this ETF is because to me this is one of the easiest and safest way to invest. It will give you an average 10% return on a year over a longer period of time, and only a few stocks can match that number. It's a great way to have steady returns, a wide diversification and also collecting a 1.2% dividend yield every now and then. I haven't bought any shares of this ETF recently, but at these prices I'm planning to buy some more. Hopefully it will drop very soon so I can buy at even lower prices. And this was my full dividend portfolio breakdown. I will do this at least once a year to give you some insights in my portfolio and be transparent about it. Do you have any feedback for the video format or my portfolio in general? Please let me know in the comments down below. My final say will be that I just love investing in a dividend company and that I can't wait to buy more stocks in the coming periods. It's a great time to invest in stocks with everything that is happening right now. And to me, dividends are a great way of generating passive income. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.